If you held Alexandria Real Estate, ticker ARE, in late October, you probably woke up to a nasty surprise. The stock tanked over 19% in a single day. Why? Because of a bombshell earnings report that wiped out hundreds of millions of dollars in value overnight. But now the story gets messier. Major law firms are filing class action lawsuits, claiming this wasn't just bad luck. They are claiming that it was securities fraud. They say that the company knew a key asset was failing but kept hyping it up, or worse, ignoring it entirely until it was too late. I'm digging into the actual documents and quarterly reports to see what really happened. Let's check the receipts. The drama centers on October 27, 2025. That's when Alexandria released their Q3 results. Here's the numbers breakdown. The market expected a standard quarter. Instead, they got a disaster. The company announced over $300 million impairment charge. In plain English, that means they admitted assets on their books were worth way less than they previously said. The bulk of the charge, little over $200 million of it, came from just one property in Long Island City, New York. This massive write-down forced them to cut down their full-year guidance, and Wall Street panicked. But the lawsuit isn't just about the money lost. It's about what they said, and more importantly, what they didn't say before the loss. The class action lawsuit alleges that Alexandria executives spent most of 25 misleading investors by omission. I actually went back and checked the transcript for their Q2 earnings call in July. The executives spent the call taking a victory lap, celebrating a massive record-breaking lease in San Diego. But regarding to the Long Island City property, that was just months away from losing $200 million in value, absolute silence. The lawsuit argues that this silence was calculated by focusing entirely on the mega campus's win in San Diego and saying nothing about the deterioration in New York. They allegedly painted a false picture of stability. Then look at the Q3 report. The moment they took the loss, the narrative flipped. In Q3 filings, they suddenly referred to the Long Island City asset as a non-mega campus property and a non-core location. They even said that they performed a re-evaluation of its alignment with our mega campus strategy. So the lawsuit argument here is, you can't let investors believe everything is fine in Q2 by omitting bad news and then 3 months later say, actually it's a non-core and worth $200 million less. Now, to be fair, let's look at the defense. I read through the risk factors and management discussions in their Q3, and they aren't hiding the macroeconomic problems. I also checked all quarterly reports 1 year back. They do mention the occupancy rate in each quarterly report, so investors technically should have this info, although it is only mentioned in the footnotes on few of the reports. The occupancy was going up, but slowly. What do you think? Do you think they should have mentioned this to investors? They explicitly blame high interest rates, reduced market liquidity, and the flaw of new supplies. But they also point to the specific industry crisis, the 25 NIH funding cuts. Their argument is likely going to be, we didn't lie or hide anything. The government cut funding to our tenants, bad economy, and the market for lab space froze. We tried to make the properties work and the occupancy was rising but slowly. When the leasing didn't materialize due to the NIH cuts and the economy, we made the responsible accounting decision to write it down. Real estate values do go down. That isn't always fraud, but sometimes it's just a bad market. So is this fraud? That depends on whether the lawyers can prove that the silence in Q2 wasn't an accident, but a cover-up. Did they know that the Long Island City deal was dead in January, but kept quiet to keep the stock price up? Ultimately, this case comes down to fine print, not a smoking gun. The company can argue that they did disclose the occupancy, although buried deep in the footnotes. I'll be honest, I didn't catch it either, until I went back and looked. It is a harsh lesson. Never rely solely on the optimistic earnings calls. You have to read the full report, footnotes and all, because that is often where the real risk is hiding. Well, what do you think? Do you think this was fraud or just bad economy? Or just a slight mishap from the management? Drop me a comment and hit the like and subscribe for the algorithm. And as always, do not lose money and safe travels.